You just paid off your credit card bill in full. Zero balance, zero interest, paid 2 days before the due date. You log into your account feeling like a responsible adult, only to get an alert 5 minutes later saying your credit score just plummeted by 30 points. It feels like a sick joke. You followed every rule the finance gurus gave you, and the system punished you anyway. Here is the truth. The credit scoring algorithm didn't make a mistake. You did everything right for your bank account, but you accidentally walked right into a hidden trap inside the scoring system. Today, I'm going to show you why paying on time can still wreck your score, the exact calendar trick that fixes it instantly, and how moving your payment date by just 48 hours can instantly boost your rating. If you are trying to buy a house, refinance a card, or just want to crack that 800 credit score barrier, this one concept is the most important lever you can pull. Most people build their financial lives around one single date, the due date. You mark it on your calendar, you set up autopay, and you sleep easy knowing you won't get hit with late fees. But credit bureaus like Experian, Equifax, and TransUnion don't care nearly as much about your due date as you think. They care about a completely different day on the calendar. Point 1 that most people ignore entirely. While building a flawless payment history that takes years of continuous effort, manipulating this hidden calendar date that resets your credit score almost overnight. If you understand how banks actually transmit your financial data, you can stop letting the system judge you on your worst financial day of the month. Let's break down the mechanics of what's actually happening behind the scenes and how to take control of it. To fix your score, you first have to understand that the disconnect between real time and reported time. Think of your credit profile like a living room and the credit bureau as an inspector taking a photograph of it once a month. If the inspector takes a photo on the day you hosted a massive party, your house looks like a total disaster zone. Even if you hire a cleaning crew to scrub it spotless 2 hours after the inspector leaves, that photographer shows up on your statement closing date, not your due date. Here is how the cycle actually works. Let's say your billing cycle runs from the 1st to the 30th of the month. On the 20th, you spend $3,000 on new appliances. On the 30th, your billing cycle ends, and the bank generates your monthly bill. That exact moment, the 30th, is when the bank takes a snapshot of your account and blasts that $3,000 balance straight to the credit bureaus. Your due date isn't for another 3 weeks, say the 22nd of the next month. So even if you pay that $3,000 down to $0 on the 21st, the credit bureaus have already spent 3 weeks calculating your score based on that high $3,000 balance. The system isn't watching a live video feed of your bank account. It's reading a static monthly snapshot taken before you cleaned up the mess. Why does that snapshot matter so much? Because it directly controls the second largest piece of your credit score puzzle, credit utilization. Your Fico score is built on 5 factors, but 30% of the entire calculation comes down to amounts owed, which is just a fancy term for your credit utilization ratio that is weighted higher than the length of your credit history and higher than your credit mix. Utilization is simple math. It's your reported balance divided by your total credit limit. If you have a card with a $5,000 limit, and that monthly snapshot catches you carrying a $2,500 balance, that your utilization on that card is 50%. To the credit scoring algorithm, high utilization looks like financial panic. Historically, when consumers start using a large percentage of their available credit, it means they are running out of cash and approaching default. So the moment your reported utilization crosses certain thresholds, first 30%, then 50%, then 80%, the algorithm panics and docks your score immediately. Picture a bridge with a weight limit sign. If a 10-ton truck drives across a 5-ton bridge, the alarm triggers instantly. It doesn't matter if the truck owner plans to offload the cargo 20 minutes later. While the truck is on the bridge, the structure is under strain. When your high balance gets reported on your statement date, your profile crosses that weight limit and your score drops. Once people discover the statement date, their natural reaction is to swing the pendulum completely the other way. They think, okay, if a high balance drops my score, I'll just pay off every single penny before the statement closes. So it reports exactly $0. It sounds logical, but logic doesn't always apply to financial algorithms. Reporting a total $0 balance across all your accounts can actually lower your score compared to reporting a tiny balance. This is what credit experts call the non-usage penalty. Or the ghost penalty. Imagine hiring a personal trainer. If you show up to the gym every day, lift weights, and log your progress, the trainer can evaluate your performance. But if you never touch a weight at all, the trainer has zero data to judge you on. They can't certify that you are strong, that they just know you are sitting on the bench. When every single card on your report hits the statement date with a $0 balance month after month, the scoring model flags you as inactive. It can't verify how you handle live revolving debt because, on paper, you aren't using any. Data shows that the highest credit scores the people sitting. They generally report a microscopic utilization rate between 1% and 4%. They show active, responsible debt management without crossing into the risk zone. So how do you actually execute this in real life without getting confused or paying a cent in interest? You use the 48-hour calendar protocol. Here is the exact step-by-step execution. First, log into your credit card online portal or pull up a PDF statement. Stop looking at the due date. Look for the phrase, billing cycle end date, or statement closing date. Let's say that date is the 15th of every month. Second, set a recurring calendar reminder on your phone for 48 hours before that date. In this case, the 13th. Why 2 days early? Because electronic transfers take time to process, and you need the funds to fully settle before the bank takes its snapshot on the 15th. Third, on the 13th, check your current balance. If you owe $1,000 on a card with a $5,000 limit, make a manual payment of $980. When the 15th arrives, the bank generates your statement, showing a remaining balance of just $20. That $20 gets sent to the bureaus, reflecting a flawless 0.4% utilization rate. Finally, step 4, when your actual due date arrives 3 weeks later, you pay off that remaining $20 balance. Because you paid the full statement balance by the due date, you pay $0 in interest, but you get the maximum possible point boost from the algorithm. You have successfully controlled the photograph. Now, there is one major mistake people make when they start playing with mid-month payments. And if you aren't careful, it can get your credit cards shut down permanently. It's called credit cycling. Let's say you have a credit card with a low $1,000 credit limit. You want to earn cash back on a $3,000 home renovation project. So, you spend $1,000 on Monday, pay it off on Tuesday. Spend another $1,000 on Thursday, pay it off on Friday. And spend a third $1,000 the following week. To you, you are being responsible because you are paying the money right back. But to the bank's fraud and risk department, this is a massive red flag. When a bank assigns you a $1,000 limit, that is the maximum dollar amount of risk they are willing to take on you in a single monthly cycle. By clearing your limit multiple times a month to spend $3,000, you are forcing the bank to underwrite 0.3 times the volume of risk they approved you for. Risk engines treat this behavior as potential money laundering or bust-out fraud. If you catch the algorithm's attention by credit cycling, the bank won't just dock your score. They may unilaterally freeze your accounts or terminate your relationship entirely. If you find yourself constantly running up against your limit and needing to clear it mid-month just to keep spending, don't cycle your credit. Instead, call your issuer and request a formal credit limit increase. A higher limit automatically lowers your utilization percentage without forcing you to play dangerous games with your transaction volume. The takeaway here is simple. Stop letting banks dictate your financial narrative based on bad timing. Open your banking apps today. Write down your statement closing dates and set those 48-hour payment reminders on your calendar. It takes 5 minutes to set up, but it will keep your credit score protected for years to come. If this step-by-step breakdown helped you understand the mechanics of your money, hit that subscribe button right now. It takes 1 second, it's completely free, and it ensures you never miss our deep dives into outsmarting the financial system. Thanks for watching, and I'll see you in the next video.